Last lesson, we have learned the repurchase agreement and the T-bill futures. In the following, we're going to study the Eurodollar futures. And before that, let's first introduce the Eurodollar market. The euro currency refers to money deposited outside its nation of origin. Hence, it is not guaranteed by any government. Euro currency trading involves the borrowing and lending of time deposits in a euro currency. The most important euro currency is the Eurodollar. It is the US dollar deposited outside the United States, and the interest rate banks pay on Eurodollar time deposits is LIBOR. LIBOR plays the role in international financial markets that prime rates do in domestic financial markets. It is a benchmark for loans. The 1-month LIBOR is the rate offered on 1 month's deposits. 2-month LIBOR is for 2 months' deposits, and so on and so forth. LIBOR is quoted as an add-on yield as per actual over 360. The interest is accrued daily, but the rate is stated as if the year has 360 days. More precisely, the add-on yield can be calculated using the following formula. LIBOR underestimates the effective rate due to the use of the actual over 360 convention. For example, if the 6 months LIBOR is quoted at 7%, its effective annualized rate can be calculated as follows, which gives 7.22%. Note that even if we use the actual convention, due to the semi-annual compounding, the effective annualized rate would still be higher than the quoted rate. However, the actual over 360 convention makes the effective rate even higher. Here's an example on calculating LIBOR interest. Suppose a $1 million 5-year loan has just been taken up with the interest rate being 6 months LIBOR plus 50 basis points. Determine the interest payable at the end of 6 months, equivalently 182 days if the 6 months LIBOR is 8% today. Since the reference rate is 6 months LIBOR, the lifespan of the loan is then divided into 6 months periods, and for each period, the interest rate is 0.5% above the 6 months LIBOR at the start of the period. Therefore, the interest due at the end of the first 6 months is the $1 million principal times 8.5% times half a year based on the actual over 360 convention. And this gives the interest of $42,972.22. Now we're ready for the Eurodollar futures. Eurodollar futures contract is one of the most heavily traded futures contracts in the world. Each contract is for a Eurodollar time deposit, having a principal of $1 million with a 3-month maturity, standardized at 90 days. It is traded on an index price basis, with the quoted futures price being 100 minus the annualized add-on yield. The annualized add-on yield is also known as the implied LIBOR forward rate. The Eurodollar futures contracts have delivery dates ranging from 3 months to 10 years. Each contract is specified by the month and year in which the futures expires. If the forward LIBOR rises, then quoted Eurodollar futures price falls, and vice versa. The long position of the futures contracts gains when the futures price rises, equivalently when LIBOR falls. Hence, one takes up long position to hedge against the rate falls. In particular, the long position is equivalent to agreeing to lend $1 million for every contract at the percentage rate of 100 minus the entry futures price. In contrast, the short position gains when LIBOR rises. The short position is equivalent to agreeing to borrow $1 million for every contract at the percentage rate of 100 minus the entry futures price. Let's take a look at an example. Suppose a long position is taken on May 1st, 2014 for a June 2015 contract at the closing price of 97.48. On May 2nd, 2014, the closing price of the contract is 97.44. Can you determine the change to the margin account? Since the futures price decreases by 0.04, corresponding to an increase in the implied lending rate by 0.04%, or equivalently 4 basis points. Thus, the margin account decreases by an amount equal to $1 million times 0.04% times 3 months, standardized to 90 days, which is equal to $100. The daily mark-to-market process resets the lending and borrowing rates for both long and short positions. From the previous example, we can see that the decrease in the futures price by 0.01, or equivalently a rise in the rate by 1 basis point, will result in the margin account of the long position being decreased by $25, or increased by $25 for that of the short position. On the contract expiration day, Chicago Mercantile Exchange uses the official LIBOR, denoted by R, and sets the official settlement price at expiration as 100 minus R. Each contract is cash settled in a final mark-to-market step using the final settlement price. For the details of how the official LIBOR is determined, one can refer to the website of the Intercontinental Exchange in the footnote. Here's an example. Suppose the closing price of a Eurodollar futures is 96.10 on the day before the last trading day. The actual 90-day LIBOR on the last trading day used for settlement is 3.84%. Determine the final mark-to-market changes to the margin accounts for the short position on one contract. Since the actual 90-day LIBOR used for settlement is 3.84% on the last trading day, the futures price at expiration is given by 100 minus 3.84. Comparing with the closing price on the previous day, there is an increase of 6 basis points. Thus, the margin account for the short position will decrease by 6 times $25 per basis points, which is equal to $150.